Fifth is index funds. Imagine owning a tiny piece of the largest companies like Apple, Microsoft and Amazon all at once. That's exactly what an index fund allows you to do. It's a basket of stocks that mirrors the performance of a specific index like the S&P 500. So you're investing in the overall market rather than betting on individual companies. For learning curve, I'm going to have to say this one is low. Unlike individual stocks where you need to dig into the financial statements and company performers, index funds are passive investments. You don't have to pick and choose stocks as they're already bundled together for you. Getting started is simple too. Platforms like Trading212 let you buy index funds with just a few clicks. Once you've invested, all you need to do is sit back and let the market do the work. For passive income potential, I'm going to say this is moderate. Index funds don't directly pay high dividends like REITs, but they still provide some income. Many companies in the fund pay dividends, and those are automatically distributed to you or reinvested back into the fund, depending on your choice. While the main focus of index funds is long-term growth, the dividend income can be a nice bonus, especially if you're investing in funds that focus on dividend-paying companies. For tax efficiency, I'm going to say this one is great. If you hold index funds in a stocks and shares ISA in the UK or a Roth IRA in the USA, you can avoid paying taxes on dividends and capital gains altogether. This means you get to keep more of your profits over time, which can make a huge difference when you're investing for the long haul. In terms of risks, I'd say it's pretty low. Index funds are much less risky than investing in individual stocks because they're diversified. Instead of putting all your money into a few companies, you're spreading it across hundreds or even thousands of stocks in different industries. Historically, the S&P 500 has delivered average annual returns of around 8 to 10% over the long term. While the market can go up and down in the short term, if you hold onto an index fund for 10, 20 or even 30 years, it's one of the safest ways to grow your wealth. However, of course, there are still risks like with any investment. So what's my investment worth now? Let's rewind to when I made this investment 4 years ago. If we head over to Vanguard's website now and we find the S&P 500 and deposit some money and then click, there you go, job done. Right, so time for the reveal. Today, that investment is worth $179.57. That's a return of 79.57%. This result shows why index funds are such a great option for most investors. They're simple, low cost, and consistently deliver solid returns over time. Personally, index funds are my favourite investment, which is why I've allocated the majority of my money there. However, I also understand the importance of diversification, so I've spread smaller percentages across all the other investments we've discussed today. This way I can balance growth, stability and risk in my portfolio. So whether you're diving into individual stocks, buying some REITs, exploring crypto, getting into gold or sticking with the steady reliability of index funds, each investment has its pros and cons. Some are better for growing your wealth quickly, while others are designed to protect it over the long term. The most important lesson is to start early. Even small amounts like the $100 we've been working with can grow into something significant thanks to the power of compounding. Time is your best friend when it comes to investing, so don't wait to get started. If you want to know what the laziest way to make money online is, then I'm going to leave that video right up there. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? I'll see you over there.